What's going on, guys? Mike here, and today we're going to have the opportunity to look over another real estate REIT that I hold in my Wealthsimple portfolio. This one is SmartCentres. We're going to look at the current developments and properties they have within Canada, as well as explore their 7% annual monthly dividends and judge whether or not we feel it's safe. We're going to take the information that I shared from my last REIT upload, which I'll link in the top right corner, and see how it compares. So without further ado, let's get started. So you'll see here on the web page, I actually just kind of started on their development tab. And I just felt like it kind of gives you a really good overview and the insight into the type of real estate REIT this one is. They seem to have a very high class expectations for buildings, and they're primarily held within Toronto downtown. So obviously those come with class just all on their own. So moving on, I just kind of wanted to kind of show here, we have just from their presentation slides from their website, they kind of just go into the detail what they have underway, active, and their future developments, which total of 274 projects. And they also lay out what their expectations are in the number of months that it'll take to accomplish these. And like I said, it just kind of shows like the amount of capital that they're reinvesting into this REIT for future growth and what we could potentially expect, in the future, right? So kind of this is a very massive slide which has 72 pages, and it's just every project that they kind of have going on is reviewed. So we're not going to go into like extreme detail into every single one of these because I feel like they could be almost a video all on their own. But if you are interested in this REIT after this video, I would definitely suggest that you actually take some time and look over all of these developments, just because they have so many of them that I can't physically cover them all. So like I said, definitely have a look through this. If I remember, I'll definitely put the link to their website in the description below for you to get those details. So one of the things I do want to highlight though within their development is they're actually starting to get into residential, which I think is like a really good move on their part, because with this, with the cost of living and everything that's happening, I find a lot of people aren't necessarily going to be able to afford homes, and they're going to have to default to renting. So they are starting their smart living initiatives that kind of it's kind of like they're buying into areas and developing residential, which could be townhouses, complexes, apartments, and also building like the retail outlets and everything close by, right? So it's kind of like a one-stop shop, so I feel it's a really good initiative, and I think it has a lot of value there. And like I said, I also feel like I'm actually kind of happy that they're getting into the residential, just because, of course, I feel like that's a market that they can easily tap into with their expertise of how to manage and play the rental game on retail outlets. So going into this, just kind of highlighting their type of rental revenues right now is that they have currently 185 properties that they manage, and right now leading at the 98% of occupancy, which is pretty standard. I think the last one we reviewed was in the 97 percentile, and a few other ones I've looked at on my own time kind of typically range in this area. But obviously, the higher the number, the more rental income we're going to have out of this particular real estate REIT. Also, too, I would typically look at this as a negative, this 25+% revenue from Walmart. Now, considering it is Walmart, it's maybe less of a stress factor just because it's Walmart, right? They're a very well-established company. The only downfall is that if SmartCentres got on the bad side of Walmart, what could that mean for this real estate REIT with having 25% income from one source? But they have had a long track record, so I like I said, it's just something to be aware of. But if it was something else that wasn't maybe as reputable, I would have more concerns. But this is just one highlight of it as a potential negative. But we don't really see too much of an issue at the same time. So the other thing is they have a pretty good plethora of different renters in their buildings. And they're all basically essential companies and very reputable all at the same time. You'll see common ones here: TD Canada Trust, Scotiabank, Dollar Tree, Sobeys, Shoppers, Canadian Tire. Like, they're all essential companies and very reputable. So I look at that as a very positive aspect as well. So I know we kind of went fast through that, but I guess me personally, I always like the financials aspects and the dividends. So that's what we're going to get into here right away. But I also just wanted to highlight, I guess, their diversification across Canada. They are primarily in Ontario, but yeah, so they are throughout Canada, but they're very limited. They have very limited exposure outside of Ontario. Now they own a lot of property though, like in the heart of like downtown Toronto, which is obviously prime real estate to own, and they kind of have the ability to kind of control what they can do because they don't really have too many competitors in that area. So that's really good. Anyways, now to the financial aspect. One thing I do want to highlight here is that over the course of the last 5 years, we really haven't seen much capital growth out of the stock, which is somewhat of a concern. And we'll get into the details once we actually see the financial report, so that I can kind of go over that. But yeah, so right now they're paying out a 7% dividend, which is extremely high in my opinion. Like usually a safe and reliable, you're at around that 5%. Sometimes like the last one that we reviewed, which again I'll link here, was in the 6th percentile, and they were only paying out 70% of their actual earnings, which is a very big positive. So we're gonna get into the details of this, and we're gonna see here. So just looking over the quick financials. In the last review, we also looked at their assets to debt. So in this particular one, we're looking at, we're just going to pull up the calculator here just for simplicity. So we're looking at 11 billion, 3, minusing off their debt here, which is 526053. So it gives us a total asset value of equity of $6.4 billion. So the other thing that I like I said before, I like to know is that, so if we look at their average weighting of numbers of outstanding, this is like their shares, which is 179,657,455. Whoop, did that probably wrong here. 1 second. 6, so it comes back at a share price of $35. So again, this number doesn't rule all or anything like that. There's some other real estate REITs that you'll actually look at that this number is actually like half of what the actual stock price is. But one thing that I just like to know is, like, if this real estate REIT were to say go bankrupt or anything like that, and they had to sell off all of their assets, well, in theory, they're actually getting they can liquidate more than the current share price, right? Which is a positive in my opinion. And like I said, it also kind of shows that you're not necessarily overpaying on the assets that are owned by the real estate REIT. So again, this is kind of a positive. They're actually quite significantly low, but you'll see here though, in 2022, they're around that $32 pre-COVID. Same thing, they were 31, so they were pretty close to this number. But again, with the whole financial crisis, people are a little concerned about real estate, so the stock price is has suffered. So that's kind of another thing. So another thing I also do want to show here is that you'll see over from 2020, 2021, and 2022, you can see the number of shares that have increased. So in my opinion, this is a contributor to the stock decline as well for the capital on it. They've been diluting shares, which is obviously decreasing the value of the stock price. But it is most likely being redistributed to debt or reinvested into the number of projects that they have ongoing. So again, the stock price is coming down. It potentially is a buying opportunity to buy these dips and get in now while we wait it out over the course of like maybe 3 to 5 years and the stock price goes back into the 30s. But again, it's a magic 8-ball scenario. We don't actually know. But while that happens, I guess you can collect your monthly dividends kind of thing, right? So another thing to kind of highlight here is I always like looking over the rental income of a REIT. And so typically you want to see this continuously growing year after year, right? You'll see here in 2019, we had about 806 million, dove down to 781 in 2020. And then came back up here to 804. So, is that a sign that, moving forward, we're going to continue on the growth pattern because we've maybe bounced back to where we were? Or is the interest rates going to hinder us and we're going to stay where we're at or potentially come down for rental growth, for revenue. So it's something to just kind of watch out for as well. So also now kind of looking, I just want to see, I actually think back here, the one thing I did forget to mention, comparing, is the average interest rate that they're paying, which is 3.86%. I would have liked to see this over 4%, in getting the numbers we are today, just because, of course, interest rates are quite high right now. So anything that's maturing is going to hurt us if their average is below that 4%, because, some of these interest rates are, 5-6% now. But on the positive side, they do have an average maturity rate of 4 years. So I do feel like there is a good amount of time on the maturity rate to allow these interest rates to come back down and potentially, hopefully be low fours. So it wouldn't be that drastic of a change at that point. But what it would hurt though is that, like, if we're used to paying 3.86, new future developments of having to finance and everything is going to hurt us, right? Which potentially could be the reason why we went from 3.11 to 3.86, is on these new developments we're having to pay a higher interest rate compared to once we were doing before. So the next thing that is always very critical is looking over the payout ratios. So you can see here, so typically the last one we did, they actually based it off the FFO. SmartCentres does ACFO, which is a little bit different. They calculate it a little bit different, but this is basically what they go off of. So again, just kind of looking what they offer us here. You'll see here in 2022 that their payout ratio is basically 97% of their net earnings, which is a bit of a concern, right? They're paying out 7% annual dividend, which is great, but they're paying out 97% of their earnings, which is a bit concerning, right? That doesn't leave much left over for reinvesting into the company and everything else. Now, typically, being in the 80s, low 90s is pretty typical. And like I said, the one we compared last week was a little bit of it's not very normal to be at the 70 percentile. But anyways, the one thing I just kind of want to show though is that, so in 2022 we're at 97, 2021 we were at 90, and just comparing to 2019 here, you'll notice we were at 92. So we are kind of on the higher scale of what has been since 2019. 2019. So like I said, a little bit of a concern. If it were to drop, I don't think it would drop like drastically. Even if it went down 20%, that still means that they're still at a 5% dividend, right? Like, it's still good. If you were looking to invest into this particular real estate REIT, let's say you had $10,000, or maybe you have $1,000, but dividing it up, let's say doing $100 a month or $1,000 a month, just in case, leading up to the next quarter, I think will probably be a big tell. So it just kind of depends, right? Like, it could potentially, the numbers could come back and their dividend payout is back down to 90 in the next quarterly report, and the stock price goes up, or potentially, maybe they need to lower a little bit. I couldn't really tell you. It's all, again, a magic 8-ball. And if you're considering this REIT, definitely always make sure you do your own due diligence. Don't always listen to what I'm doing. What works for me doesn't maybe not work for you. So moving on, so we kind of know about the dividend, where it's a little up in the air right now. One thing I do want to show though is the history of their dividends, right? So you can see here, I'm not sure, I never actually clicked the max button, but you can see since 2004, it's actually been increasing. They were kind of stagnant from 2008 all the way to 2015, has been increasing, and then since 2020 they haven't increased it. So if you're looking for a little bit of like reassurance, this business obviously knows what they're doing, because like even through the 2008 financial crisis and the 2020 crisis, they haven't actually like skipped any dividends. So consecutive years of dividend payment here, it says 20 years. That, like, 20 years of consecutive payments has some value in reassuring an actual investor, right? So that's just something I wanted to show, just because there is value there. And like I said, I have shares in this particular REIT. I bought in about last year. I have no intentions of selling it right now. If the dividend does go down, I'm okay with that. I'm a long-term investor. I plan on holding it for a number of years. So as we come out of this high interest rate environment, I'm expecting that these values to go up. So that's just kind of something that I'm doing. One thing I do want to point out though from the last REIT that we did is that Plaza REIT has never really increased their dividend. They've been paying their 2% monthly dividend or 2 cents of monthly dividend and never really increasing it. Whereas in comparison to this one, you can see that they actually seem to have a bit of a plan of increasing it. And that's a nice thing, because when inflation is going up, you also want to have those dividend increases so that your money is staying consistent with the value of the dollar, right? So just something to kind of point out there. So another thing I did want to point out, and this is based off of since 2018, is that their compound annual growth rate has only been 4.24%, right? So they've been paying out, roughly anywhere between 6% to now 7% dividends, but their actual total return, which is what the most important thing is only been 4.24%. So not great. If we wanted to actually do a comparison to the REIT that we had looked at earlier, which is Plaza REIT, let's see if this loads here. Looks like it's gonna be angry. I'm just gonna refresh the page here. Hopefully that fixes it. Okay, well, it's not loading, but anyways, I know the number. It was at 9% compound annual growth rate. So when you're comparing the two REITs, now this is a much larger cap versus the Plaza REIT being a bit of a smaller cap. Like we're dealing, like Plaza REIT's like a $400 million real estate company, whereas this one I think is in the billions. So let's just have a quick peek at that. So let's do SRU.UN stock. Sorry, a lot of this is improv. But yeah, so market cap of 3.77 billion compared to Plaza REIT being at 400 million, right? So there's this is a much larger company, but they're doing a lot of reinvesting, so maybe that's affecting their annual growth rate, which maybe longer term, maybe this will go up a lot more. I don't know, right? But again, I still have it in my portfolio. I want to be diversified. I don't hold real estate REITs as like my core holding, but I still want to be in the real estate market, right? So like I said, I think overall, like with all of my investments, like I only show a portion on the Wealthsimple reveal here on this channel, but I think if I did like a full overall, I'm only like maybe 4% out of all of my investments into real estate. So it's not a drastic, like a large number, but some people are more, like they can be at the 20%. But again, if you're doing 20%, I wouldn't say put 20% into this particular REIT, diversify into a whole bunch of different ones. There's also real estate ETFs where you can buy into one stock ticker symbol and it's diversified across a whole bunch, right? So like there's healthcare, there's industrial. These ones are retail. There's Granite REIT, which is just primarily a residential REITs, right? So there's a whole bunch of different ones. I like, you should consider bouncing it around as to which ones you want to put your money into. I personally don't like doing the ETFs just because I feel like the real estate REITs are there's not very many of them. So instead of paying a cost for the expenses of the actual ETF, I personally feel I can just buy the real estate REIT myself. So, but that's just my own 2 cents. So one thing I do want to compare to is that their top competitor, which is, I'm going to do a review on this particular REIT as well in the future, and this is RioCan. Now I hold this one as well. It's in my RSP. Now RioCan, they did, just as a quick highlight, they did lower their dividend. And so, but they're still paying that 5.44%, which again is still really good, but they did lower, I think it was last year, I'd have to look it up again. But I do find what we'll show in the next one is that these guys may be in a better position to weather the storm of these high interest rates because they did lower their dividends. And again, I want to point it out that lowering dividends doesn't necessarily mean that it's a bad thing, right? Sometimes they do need to lower it because of current market conditions, and obviously we want them to succeed as a company. We don't want them to go bankrupt, because then we're going to lose, a lot more money than a little bit of a couple percent on a dividend payment. So other than that, I hope you guys got some value out of this. If you did, definitely, subscribe to this channel for future videos. I have a lot of plans for this video, and I really hope it takes off. But definitely leave any comments if you have any. I'd love to help you guys out. But after that, yeah, like I said, hopefully you enjoy the content, and I'll see you in the next one.